Good afternoon, everyone. So, today we will see the third chapter in this series of interest rate derivatives, which is on the interest rate futures. So, till now we have seen the interest rate products, the features of the interest rate market, and how forwards are executed, how FRAs are executed and computed. We will now move to the exchange traded products like futures and options and see how the dynamics of the markets are and how the calculations happen for the futures contract and why there is a need for the futures market, specifically for the bonds and the interest rate products. Now, this is the high level learning outcomes like what is the interest rate futures, understanding the payoff structures, how the contracts are defined and executed, and what is the reason for a futures market to exist. So this is the high level understanding that we will do over the LOS. In this, you will understand the fundamental concepts. Payoff structures is basically whenever you take a long futures, what is the profitability and the loss diagram. And if you take a short future, then what is the profitability and the loss diagram. So we will understand for each of the leg of transaction, what is the maximum profit possible, what is the maximum loss possible, what is the break even point, how the contracts are quoted in the market in terms of yield or in terms of price, the lot size of each of the contract, right? Like in equity, we know that for each of the script, we have a lot size. Similarly, in bonds, we have a lot size to purchase any futures or options as per the market definition. And lastly, we'll see what is the market applications where and who can use the bond futures or the interest rate futures market either to hedge or either to have a speculation on the yield curve, or it could be simply a part of the diversification strategy. So this is the overall high level learning outcome. Interest rates. So interest rate futures is basically a standardized contract on a recognized stock exchange for purchasing or selling a security. In this case, the security could be a bond or a money market instrument. Money market instruments are those instruments which have tenure from 1 day to 365 days. So they mature between 1 day to 365 days are known as the money market contracts, money market products and money market contracts. Now, why will you buy a bond future? See, suppose you are expecting the yields to go down. You are expecting the yields to go down. What will happen to the price? The price will go up. So now if you enter into a future today, you are expecting the bond prices to go up. The bond prices to go up. So you lock in your price today, and when the prices go up, you sell in the market and make a profit. That's the basic concept of buying any futures, that you are bullish on the underlying price. In this case, the underlying price is linked to a component called as yield. Whenever the yield in the market goes down, the price of the bond increases. So what are the key characteristics of a futures contract? Similar to the equity and currency derivatives, it is standardized in terms of the lot size and the contractual terms. It is traded on the exchange, so there is no risk over here because there is no counterparty risk because there is a central clearing which is happening. It is regulated since it's on exchange. A guaranteed settlement, again, because it's on exchange, there is a central clearing party, a central clearing market, which will make sure the buyer is paying the money and the seller is delivering the security. And this is very important, mark to market. Now, similar to equity and currency derivatives, futures are marked to market on a daily basis, and if the purchaser of the future is in an MTM loss, a mark to market loss, he has to furnish the maintenance margin, also known as variable margin. He has to furnish the maintenance and variable margin on daily basis to the exchange to keep his holding live. In case he fails to do the settlement of the mark to market, exchange or the broker will have the right to square off the position and recover the money. So this is the overall introduction of interest rate futures. So how interest rate futures work? So we discussed that it's a standardized mechanism. That means the lot size is fixed and the parties are centrally cleared through the CCP and exchange traded. So the order taking is happening on the exchange. So there is no broker dealer market. It is getting executed automatically through a standardized mechanism. So what are the three parts? Contract initiation. Party agrees to the terms through exchange platform with initial margin deposit. Why is this initial margin deposit required? It is similar to equity and futures. Remember over here in equity and in futures and options, either of bond or of equity, you are actually buying lot size. You are actually buying the lot size. You are not buying one bond. You are buying a lot of bonds for a very small amount of exposure. So that is why an initial margin is required, because you are actually not buying the bond. You are saying that you will buy the bond in futures. You will buy the bond in future because you're entering into a future. So today you have to pay the margin which is required to enter into the contract. Daily settlement, similar to equity and currency futures, the mark to market happens daily on the bonds and the underlying, and whatever is the profit or loss from either of the party, buyer and seller, has to be uh, you know given to the exchange or to the broker on daily basis. And if they fail to do so, they have the right to square off the position. And this is also known as maintenance or variable margin. Known as maintenance or variable margin. So in anywhere if you come across this term as maintenance or variable margin, remember this is to post the mark to market gain loss. And final settlement, cash settlement or physical delivery. Now cash settlement, suppose I enter into a futures contract and I want to exit the contract. If I want to exit the contract before the maturity, I can choose for a cash settlement. That is whatever is the gain loss difference between the price, I will take the differential. Suppose I actually want the bond. Suppose I actually want the bond as part of my purchase. I will take the physical delivery from the seller of the bond and I will keep this bond in my inventory. So settlement can happen in two ways. One is the cash settlement where the bond is not actually delivered to the buyer. And the second one is the physical delivery where the seller will have to deliver the bond to the buyer. So these are the three topics that you need to remember: contract initiation and standardization of contract, how the daily settlement happens in terms of the mark to market calculation, and at the time of maturity or before maturity, if you want a cash settlement, you can exit the contract by taking the differential or by taking the actual delivery of the bond. Next, let's understand what is long and what is short positions. So anything which is long, that means you are bullish on the price. Short, that you means you are bearish on the price. That's fundamental. So agrees to buy the underlying at a contract price. Profits when the market price rises because you are bullish. Profits when the market price falls because you are bearish. Exposed to risk if the price falls. Mainly used to hedge against falling interest rate. Why? What happens when the interest rate falls? The prices go up. And if the prices go up, the bond that I want to buy will be expensive. So I generally hedge it so that in case the bond prices rise, if the bond prices rise in future, I will make a profit. And the opposite of that is true for the short seller, wherein he is expecting that the rate will rise and the price will fall down. So this could be a seller of the bond, this could be a buyer of the bond, because a buyer is thinking that the price will go up, let me buy today. Seller is thinking that the price may go down, let me sell today at a better price. Let's understand the payoff charts for the long position. So we know long position will benefit when the prices rise. When the settlement price exceeds the future price, the long position generates profit equal to the difference multiplied by the contract size. So similar to equity and currency positions, the difference in price, let's say PF, which is the future price, or PS, which is the settlement price, minus PF into the contract size. PF is the futures price. So when settlement price exceeds the futures price, you make a profit. Break even point, that means there is no profit, no loss when the settlement price equals to the future price. Obvious, if your settlement price is equal to the future price, you are neither making any profit, neither you're making any loss. When the settlement price falls below the future price, now suppose this PS goes below PF, then there is a loss. And how will the diagram look like? See, this is the profit scenario. Profit scenario, it can go up till virtually whatever price the bond can go, and the loss is limited because the bond price can go only up to 0. So this is the loss scenario and this is the profit scenario. So there is a difference between this payoff position and the call option payoff positions. The reason is because the call option, you enter into the contract by paying a premium. So there is a slight difference that we'll understand when we do the options. But for now, just understand a futures position will have such a payoff diagram where the profit could be virtually whatever the bond price can go up till say 110, 115, whatever. Because unlike equity market, bond prices cannot go up, infinitely. They will go up to a certain price. And on the downside, obviously, the bond can go to the bond can default, and obviously the price can go to 0. So that is the downside. So net long position will benefit when the settlement price is greater than the futures price. So this is on the long position. Now let's see the short position. Now in the short position, the reverse is true. Now when you are in a short position, that means your expectation is that the price will fall. Your expectation is that the price will fall. When the settlement price falls below the future price, when the settlement price falls below the future price, that is when you make profit because you are selling. So your price should go down. Break-in point, again, no profit, no loss when both of them are equal. And loss is when the price, the settlement price is greater than the futures price. So opposite of the long position. Over here you can see the payoff diagram. It shows that the profit is limited because the loss on the bond can go up till the price when the price of the bond is 0. Beyond 0, the price of the bond cannot go, right? So the profit is capped till the bond price goes up to 0. And losses can be virtually unlimited, but obviously, as I mentioned in the previous slide, the bond prices, unlike equity, cannot go up infinitely. So the losses are exposed as and when the price of the bond increases, the short position incurs the loss. So that was the basic understanding of the payoff charts for long position and short position. Again, let's recap. The long position benefits when the settlement price is greater than the futures price, and the short positions benefit when the settlement price is lower than the futures price. So this is the main difference and the payoff charts for the long and short positions. Good afternoon, everyone. Now let us see the specifications of the contract of the futures contract for the bond or the underlying interest rate product. The underlying asset could be an instrument which is quoting an interest rate, or it could be a notional security. What does a notional security mean? Say suppose I want a contract of say 6% yield maturing in say 3 months. Suppose there is no bond which is matching to this kind of a contract. So this becomes a notional or a virtual security, and at the time of settlement from the basket of securities which are available, the seller can deliver any of the security which matches closely to these terms. So this is a notional security. Underlying asset could be a bond or a notional bond. Contract size, the notional principal amount or face value of the underlying contract. So here the face value could be 1 lakh, it could be 2 lakh, depending on what type of bond it is. Quotation is done typically in the yield or price term. So I can have a 6% YTM bond, or I can have a bond which is quoting at 101.457 example. So when you get into the futures market, the yield quotation could be like this, or the price quotation could be like this. Tick size is the minimum price movement allowed in one contract. So this is basically if the bond price is 101.457 and the minimum tick price is 0.50, so the next contract will be at 0.50 points ahead of the previous price. Contract months, specific months in which the contract expired and settled. Over here we saw 6% YTM 3 months. So your contract period is 3 months. Settlement method, we saw cash or physical. Cash means the bond is not actually delivered. The differential of the price is settled. Physical is where the seller will actually give the bond to the buyer. The seller will actually give the bond to the buyer. The physical settlement happens when the buyer of the bond actually wants the bond in his inventory. So as I mentioned on the earlier slide, underlying assets in interest rate future could be bonds, specific securities, and interest rate themselves, right? I can have a view that the interest rate will go up or it will go down. So that becomes one of the underlying asset. Notional bonds or theoretical bonds we discussed in the previous slide. Say suppose I want a 6% YTM 3-month bond, and such a bond does not exist in the market. So a theoretical bond trading happens, and when at the time of delivery, from the basket of deliverable bonds, a bond is selected which is very close to the actual contract. Now that happens with the help of a conversion factor, which we'll see in the subsequent slide. Where does this conversion factor comes from and what is the role? But for now, understand that the underlying asset could be an interest rate itself, where I have a view on the interest rate. It could be a notional bond or a theoretical bond, and it could be a specific security. Suppose I want a tax-free bond and I want to purchase it in the market. I can actually enter into futures contract to purchase this security from a seller in a futures market, and at the time of delivery, I will take a physical delivery. So this are the 3 types of underlying assets in an interest rate futures. So now let's come to the contract size. Minimum lot size is 1. Trader must buy or sell at least one complete contract. Fractional contracts are not permitted. That's okay. We understand that. At least one quantity of contract should be bought or sold. Typical contract size face value is 2 lakhs. So you cannot have a contract less than 2 lakhs. 100% standardization means that the buyer and seller are buying the same contract and there is no ambiguity in the contract. Since it is exchange traded, the contracts are predefined, the settlement is predefined, so there is no risk and it is 100% standardized. So remember that the minimum size is 2 lakhs and the minimum lot size is 1. The tick size is the minimum price movement. So as I explained earlier, suppose the price is at 101 and the minimum tick size is 0.50. The next trading can happen only at this. So there could not be any order which can be placed at 101.25. Such an order will be declined because the tick size is minimum 0.50. So the next order will be taken at 101.50, or it can be taken at 99.50, which is on the lower side, and this on the 100.50, which is on the lower side, and this is on the higher side. So calculating the tick value is contract size into the tick size. Let's say an example, a 10-year Government of India security, contract size is 2 lakh, which is the minimum value. Tick size is 0.25 basis point. So when you say basis point, you basically divide it by 100. So 0.25 divided by 100 will give you this. So when I multiply 0.25 basis point price movement equals 5 rupees 5 profit or loss. How? This will be 0.25 basis point into 2 lakhs. So every price movement will result into 5 rupees plus or minus depending on the direction of the security. And how did we compute this 5 rupees? It is the contract size into the tick value. Contract size into the tick value. So over here, 2 lakhs into 0.25 basis point. When we say basis point, it is 0.25 divided by 100. So when you do the maths, you will come up to rupee 5. So that is the minimum ticket size or the minimum rupee movement that will happen for each of the bond on the either side, either on the plus side or on the minus side. Then we come to the contract months and expiration. So near month is basically current or next month. If I'm entering into a contract which is ending in this month or it is ending in the next month, this is a near month contract. Middle month is expiring in 2-3 months, moderate liquidity. This is the middle month, this is the near month, and this is far month. Longer dated contracts, lower liquidity, useful for long term hedging. Long term. So why will I enter into something which is so long term? See, what can happen is I might have a view on the interest rate, or I might have a hedging strategy which is long term in nature, because I might have a liability at this end. Suppose I have a 100 million liability at 12 months from now, and I want to hedge the interest rate. I will enter into a long term futures contract which will expire near to this liability, so that this liability is hedged and my balance sheet or my investment strategy is completely hedged. So in that scenario, I will enter into a long dated contract where my liabilities are long term. Again, quotation methods. Quotation method means when you log into the bond portal, there will be securities will be listed like this, like it's in equity market. So how are the securities quoted? The securities are quoted in yield terms or in price terms. So in yield terms, it will be like 6% bond. Price terms, it will be like 100.50, right? So these are the two different types of quotations which are available. So yield is expressed as percentage, 6%. Inverse relation with price, that's okay, we know that. Used for T-bill futures and MIBOR futures. Used for T-bill futures and MIBOR futures. If you see this, yield base is mostly coming in the money market instruments, which is 1 day to 365 days tenure. T-bill is typically 1 day to 365 day, and it is discounted. The T-bill is a discounted instrument. And then opposite to that is a price based. As I mentioned, the bond can be quoted in terms of price, specifically used for GSEC and bond futures. So non-money market or the bond market products which have maturity greater than 365 days. So when you enter into the futures market, these are the two type of quotations which are available. The bond can be quoted on a YTM basis, or it can be quoted simply in the price basis. The reason why it's quoted in the YTM basis is basically for money market instruments, since it is discounted, the yield makes more sense because there are no interest payments over there. So the yield makes more sense over there. In the GSEC, which is the interest or coupon bearing instrument, the price is much more easier to understand in terms of the trading of the bond futures. So at some point of time, they will converge, and that will settlement method we understood in the previous slide, cash settlement. When will I do the cash settlement? When I don't want the bond. I don't want the bond. I don't want the bond, but I want the differential profit or loss. Most common for interest rate futures, on expiry, the difference between the futures price and the settlement price into the contract size is your profit. Eliminates delivery logistics. Why? Because I don't want the bond. I just want to profit from the difference of the prices. In physical delivery, less common for interest rate futures, the short position delivers the securities. The short position delivers the security, actual transfer of security. Conversion factors applied. Now, in the previous slide, we saw that there could be a notional or a theoretical bond. What is theoretical bond? Suppose I want to enter into 6% YTM 3-month contract. But such a contract is not available in the market. So a theoretical contract is entered into, and at the time of settlement, from the basket of securities which are available, a security will be picked and a conversion factor will be applied to it such that the price and the yield of the security matches with the contract that I have entered. Now this is an automated process. It happens based on the basket of securities and the available data. So we'll not go into the actual creation of the baskets and other things, which is from an inventory perspective. But now, for now, just understand that the physical delivery of a security can be a simple GSEC bond or a tax-free bond, or it could be a theoretical bond which is not existing in the market. But when applied a conversion factor from the basket of securities, the yield or the price matches to the contract amount. So this is on the settlement method for the interest rate futures. Now this we have already discussed. Exchange traded instruments are valued on the end of the day. End of the day when the prices are there, a mark to market is done. And if the buyer is in loss, he will post the margin. If the seller is in loss, he will post the margin. This margin is required because the exchange has to protect both the parties. If any of the party will default, the other party should get the money back. So that is why a margin requirement is required for whatever plus or minus of the uh, valuation happens, like a profit or loss. So that amount has to be posted. That is known as variable margin, or also known as maintenance margin. So calculation is difference between previous day settlement price and today's settlement price. Obviously, margin adjustment gets credited to margin account. Losses are debited. Margin calls issued if the value goes below maintenance level. See, exchange will say that at any point of time you have to maintain X% of your open position as the margin, not open position as, or your MTM as the margin. If the margin amount which is deposited in the margin account goes below this value, the exchange will issue a margin call. Issue a margin call means your broker will give you messages on your portal, or it will email you that your positions are going below the maintenance margin. Please furnish more cash to sustain the margin, or the broker has the right to square off your position. The broker has the right to square off your positions because you failed to provide the margin. So this is the definition for the margin calculation and margin adjustment. Now initial margin and maintenance margin. So as I mentioned in the previous slide, maintenance margin or variable margin, what it is known as. When are these paid? Okay, now let's say I am entering into a contract, a 3-month contract for a futures, and this is day 0. On day 0, I will pay the initial margin to enter into the contract, 2 to 10% of the contract value. It is used calculated using the span margin. Not important, just remember the name, span margin. Held by clearing corporation, central clearing party. Can be cash or approved security. Initial margin is paid at the initiation of the contract and has a 2 to 10% of the contract value. Maintenance margin is the minimum balance that must be maintained in the margin account. So the margin account says X percentage of your P&L should always be there. It is 75 to 80% of the initial margin. Suppose initial margin over here was 10 lakhs. The maintenance margin would be 8 lakhs. Triggers margin call if breached. If this X percentage goes to 7 lakhs, a 1 lakh margin call will be issued because now it has gone below the minimum maintenance criteria. As I mentioned, it protects against the default risk because the exchange has to make sure the buyer and the seller of the futures are protected in case any of the party defaults or fails to furnish the cash. Now let's see a practical example of a contract. Here the contract is of 2 lakh minimum value and 0.25 is the tick size, that is 0.25 divided by 100. Now if the price moves from 98.5 to 98.75, why 98.75? Because from 98.5 to the next tick has to be at least 0.25 basis point above. So 98.75. How many number of ticks will be calculated? See, the change is 0.25 per 100 face value. So 0.25 divided by 0.25 basis point, which is this one, tick size. I will get 100 ticks. That is 100 ticks. Now the value calculation, how much the contract value will change in rupee term. Now 0.25 basis point, that means 0.25 upon 100 into 2 lakhs will give us 500 per contract. So the long position will benefit by rupees 500 if the price moves 0.25, and the short position will have a loss of 500. So a 0.25 tick in the price will result into a rupee 500 profit or loss for the purchaser and 500 loss for the seller. So straightforward calculation for interest rate futures. This is basically telling you what is the expected contractual value change. So if you enter into a contract at 98.5 and the price moved to 98.75, in actual cash and in actual rupee term, your profit or loss will be 500 based on the number of ticks. So now let's see what is the rationale for these exchange traded products to exist in India. Okay. So as we have seen earlier also that derivatives is majorly used for risk management and hedging, right? Because if I have a long exposure to the interest rate or I have a liability which is exposed to interest rate risk, I need to hedge my exposure by means of taking an opposite direction in the interest rate product, right? For this I would require a product which is easier to manage, easier to enter and exit, and it is protected by the exchanges and the clearing parties. So interest rate derivatives, specifically interest rate futures, help in hedging the interest rate risk. Regulatory oversight, structured framework with clear rules and surveillance mechanisms. So we have discussed this. Why an exchange is required? Because now the buyer and seller are free of the concern of a default or free of a concern of a delivery failure, right? Because there is an exchange in between, the maintenance margin has to be provided, the delivery has to be given of the bond, and the exchange makes sure that the mark to market settlements are done on daily basis, so that either of the parties are free of the concern of defaulting on the margin payment or on the delivery payment, right? Transparency, obviously, if it's an exchange traded product, the transparency is there. You know what is the buying volume, how much, what is the buy price, what is the quoted market price, what is the liquidity in the market, and so on and so forth. Price discovery, transparent platform leads to better and fair value of interest rate instruments. Why? Because if it's an exchange, there will be continuous buying and selling request. When the market is efficient and there are continuous buyers and seller, the asset will come to its fair price, because buyers will not will to pay more than its fair price, and seller will want to maximize their benefit. So at some point of time they will converge, and that will become the fair price of the instrument. Market access and counterparty safety is, we have discussed earlier, counterparty safety, because there is a central clearing party which is CCIL, clearing corporation, which helps in clearing of the obligations from either party. Hence there is the default risk is quite lower in an exchange traded instrument. Advantages of futures over FRAs. This also we have discussed earlier. Futures easy exit because it is on exchange. You don't need to go and find a seller or a buyer in the market. Multiple maturities. You can take a near month future, or you can take a medium month future, or you can take a long term future, say 10 months and above. Secondary market is active. That means at any point of time there is a buyer and seller in the market. So there is no liquidity issue. If you want to exit your position, there is always a buyer and seller in the market because it is exchange traded. Can increase or decrease exposure as market views changes. Okay, now this is important. Say suppose I have an interest rate liability or an asset, and I want to and I have a specific direction on the interest rate. I am expecting it to go up, or I have to expect it to go down. Now, if the trade moves into my direction, I am making a huge profit. I want to double down on that. I want more quantity of the same contract. This will be very difficult in a market where it is an FRA, because I'll have to tell the broker to find a seller for me. Then the broker will go and find in the market who is the seller. And the buyer and seller will agree on some terms and disagree on some terms. So this is quite time consuming. But in the futures market, I can just go and buy more lots and increase my exposure. And what is the operational advantages? No credit lines, obviously, because this is going through the central clearing. So every day mark to market settlement has to happen. Lower transaction cost because it is exchange traded. So it's only the execution cost and the charges that are applicable. Transparent pricing, we have discussed this because of the buyers and sellers, the participants in the market. The price comes to a fair price or an acceptable price, which is applicable to all in the market. Simplified documentation, exchange requirements for documentations are quite straightforward and quite standard for each of the participants. So which removes the risk of legality, because if you enter into a FRA with a second party, you will be exposed to the legal risk, because this guy can actually go and sue you in the market, or you can go and sue him in the market and put a case against him, because this is a broker dealer market. But in the exchange traded products, everything is simplified, everything is standardized, and it is same for all. So once you enter into an interest rate futures, your legal risk, it's gone, right? So these are the advantages of futures over FRA. Obviously, FRA also has a lot of advantages over futures. We'll see that in the subsequent slide. But for now, just understand that one of the key features of futures contract is liquidity, transparent pricing, less legal and counterparty risk, and the ability to double down or increase your positions significantly in a very short period of time. Now, how is an interest rate futures computed? Let's see with an example. Now, there's a word written over here, cost of carry model. I believe that you must have seen this in equity and forex derivatives. Basically, cost of carry is if you want to carry the current position into the future, what is the cost to carry that position into the future? So this is your current position, this is your future position. If you want to carry the current position into the future, what is the cost for that? So the futures price is spot price into 1 plus rate. Let's say for simplicity purpose, let's say it as rate. We'll not do T by 365 because this is for the time period. Let's say for the simplicity perspective, this is the future formula raised to n, in how many number of periods you want to go. So the futures formula for, say, suppose a spot price of 100 and the risk-free rate is at 6%, and I want to see 1 year down the line what will be my future price. This would be my futures price. The formula assumes no arbitrage opportunity exists between the spot and future markets. No arbitrage means there is no buying and selling benefit in the spot or future market. The future market is correctly depicting the spot market. That means this interest rate, it will not change. This interest rate will not change. Only then the future price will be equal to the spot price into 1 plus 6%. So that is the assumption that there is no arbitrage opportunity existing. Why do we need the cost of carry formula? Let's understand. This is a futures contract. That is, today you're not entering in, you are entering into it today for a price in future. Now this future price is exposed to risk. The price might change, the yield might change, the rates might change, right? Anything can change. So this is exposed to those risks. Now, if it is exposed to that risk, that means the future price could be lower than what you anticipated. But what the cost of carry formula says that there is no arbitrage opportunity existing between spot and future market. That means assumption is that 6% will remain more or less the same throughout the period of the contract. So for now, just remember the formula: forward or future price is spot price into 1 plus R raised to n. N is the number of periods that you want to see in future. Or that is more for a future concept. Here you can simply say the T is basically the time period. I have used N, and 365 is because you want to annualize the interest rate. So 6% is an annual interest rate. If the period is less than 6%, it will be 6%. So suppose the period is 3 months, it will be 3 by 12. or in days it will be 91 by 365. So that is what it is signifying, T by 365. Now, what are the factors which are affecting the futures pricing? Self-explanatory. So let us see the futures price formula again. Spot price into 1 plus R. As of now, I'll just take R. I'll not use a T by 365 because I explained you why it is used. So what are the factors? This is the interest rate. So this is the first factor. Interest rate affects the futures price. Time to expiration. The formula had T by 365, which is time. So that longer the time until contract increases the cost of carry component. Obviously, if I have a 1 month future, the future price will be very close to the spot price. If I have a 4 month future, the future price will be little far away. If I have a 10 month future, the future price will be higher than the spot price significantly because there are 10 months to expiry. Expected rate changes, again, if this rate changes, the future price will change because assumption is no arbitrage. For bond futures, accrued interest and coupon payments during the contract period affect the theoretical fair value. Now, what happens is in the bond futures, suppose there is a coupon payment here and there is a coupon payment here and the bond is traded over here. Now, from this to this period, there is some accrued interest in the bond that will be shown in the bond price. And if the coupon is paid, suppose you are buying it at here on the coupon payment date, it will return back to its clean price. So it's saying that the bond futures accrued interest and coupon payments affect the theoretical fair value of the price. Supply and demand is self-explanatory. If the supply of bonds is more, the prices will go down. If the demand for bond is more, the prices will go up. It's a simple supply demand concept. Then market liquidity, again very similar to supply demand. If the market is liquid, the bond will tend to trade closer to its fair value. See why? See, the price has a component of liquidity premium. What is liquidity premium? Liquidity premium means an ability to buy or sell an asset. Okay. Suppose I want to sell an equity today, I can go in the market and sell it. But if I want to sell a real estate, if I want to sell my home, I cannot go immediately and sell it in the market, right? There is a liquidity window. There's a time window which is required to get that liquidity, right? That means the price that I will get for my house might not be the fair price because I have to wait for the correct buyer. But if I want to sell my equity, I can go and sell it in the market. So my equity will always be closer to its actual trading price because there are sellers and buyers in the market. But an illiquid asset or an illiquid bond will be far away from its fair price because it has a liquidity premium. That means there should be a buyer or there should be a seller for the bond in the market. And for that, a lot of time the bond prices depict that there is a liquidity premium in the bond price. Sellers and buyers in the market next we'll see pricing example of a T-bill futures. Now T-bill, as I mentioned, T-bill is a money market instrument. So 1 to 365 days will be its maximum tenure. Current T-bill is 98.5, expiration is 30 days. So between 1 to 365 days, 6.5 is the yield or the repo rate. Contract size is 2 lakh. Cost of carry, again we'll put the formula. Futures is equal to spot into 1 plus R. Let's understand. Spot is 98.5. So 98.5 into 1 plus R. R is 6.5. But this 6.5 is for the entire year. But the contract is only for 30 days. So I will divide it by 365 so that I get it only for 30 days. Once I do this, I get the value of 0.526. Now this 0.526 will get added to the price and I will arrive at the futures price, 99.026. So let's revise it again. The future price calculation is spot into 1 plus R. Spot is 98.5 given over here. R is 6.5, but this 6.5 is per annum. And the contract period is only 30 days. So whenever you want to analyze any contract, you divide it by 365 because the 6.5 is for the entire year and for 30 days it will be divided by 365. You get the value of 0.526, you add it to the current price and you get the future price. So that means 30 days from now, the T-bill should trade at 99.026. If it is not trading at 99.026, that means there is a arbitrage opportunity to either buy or sell this bond in the future market, right? So that's what written over here. If the actual price is deviating significantly from 99, arbitrary opportunity exists. Okay, now this is important, conversion factor for bond futures. Now, why conversion factors? Bond futures often allow delivery of multiple eligible bonds from a basket. Now, we discussed that there could be three types of interest rate derivatives. One is on the interest rate itself. It could be MIBOR rates, repo rate, something like that. Third could be the actual security delivery. Say, suppose I want to have a Government of India bond in my inventory, I will go and buy the interest rate future. Third is I want to buy a 6% bond maturing in 3 months. But suppose there is no such bond in the market. There is no such bond in the market. The closest bond to this is a 6.25 bond or a 6.15 bond. These are the two different bonds, but I don't have a 6% bond with a 3-month maturity hypothetically in the market. Now, what will happen once I enter into this trade as interest rate futures on the notional bond, at the time of delivery from this basket of securities, 6.25, 6.15, 6.05, like this, a lot of securities will be there. The bond with the cheapest to delivery CTD, cheapest to delivery means for the seller, it is the most cheapest to deliver this bond to the buyer. That will be used, and to compute the price, a conversion factor. Why this conversion factor? Because I am having a bond of 6.25, but the contract is of 6%. So 6% will have a price say X and 6.25 will have a price of say Y. Now to make X is equal to Y, I will have to use a conversion factor. This conversion factor will make sure the X is equal to Y, so that the bond which is to be delivered will be the one which will be used to will be the one which will be computed based on the conversion factor. Again, let's revise it. I enter into interest rate future of a notional bond, 6% expiring in 3 months. But in the market, there is no such bond, but there are different types of bonds, 6.25, 6.05, 6.15. At the time of expiry, when I have to deliver this bond, the seller has to deliver this bond, he will go into this basket and look for a bond which is similar to this. But this bond is at 6%. These bonds are at 6.25, 6.05. So 6% will have a value X. These bonds will have, say, example value Y. To make X is equal to Y, there will be a conversion factor. There will be a conversion factor which will be used. And that will be based on the cheapest to delivery. Cheapest to delivery. Out of these three options, whichever bond is cheapest for me as a seller to deliver, I will deliver that bond. So let's see an example. A bond of 6% coupon. Deliverable bond is 7%. So I entered into a coupon of 6%, but in the basket, the coupon is 7%. So over here, the bond is of 7%. Conversion factor is 1.0856. So the future price calculation is like this. Adjusted delivery price is futures price into the conversion factor. So whatever will be the future price over here, say 98 into the conversion factor, 1.0856. That will be my future price. So we'll see the example for this. So now let's see what is the concept of cheapest to delivery bond. Now, while multiple bonds are eligible for delivery against a futures contract, the short position will choose the cheapest to deliver bond. Now you have a basket of bonds, bond 1, bond 2, bond 3, and say the futures contract is at 6% YTM for 3 months. Now there could be a bond at 6.5, 6.8, 7%, right? The exact bond of 6% YTM is not available. So there are multiple bonds which are available which the seller can deliver. He will choose the cheapest to deliver bond. Cheapest means it must be at the lowest price to deliver the bond to the buyer. Now for each eligible bond, The calculation will happen like this. The market price plus accrued interest, say market price is 100.95 plus accrued interest 0.05 example, minus the futures price into the conversion factor. This is the delivery cost. Now the seller will compute this delivery cost for each of the bonds, bond 1, bond 2, bond 3, and the cheapest delivery cost bond will be delivered. Lowest delivery cost bond will be delivered. CTD bonds tend to trade more closely with futures price. Other bonds may show basis. What is basis? Basis means difference in price. So we'll see the basis risk in the subsequent slides. But for now, just remember that if a seller is entering into an interest rate futures and he is entering into a trade where the bond is notional in nature, he will have to deliver this bond, but this bond does not exist because this is a notional bond. So he will deliver the bond from the baskets which are available. From these baskets, he will apply this formula and the bond with the lowest cost will be delivered, hence making it cheapest to deliver bond. So from the cheapest to deliver bond, we found that the cheapest to deliver bond will be close, the price of cheapest to deliver bond will be close to its futures price. Other bonds will show a basis risk. What is a basis risk? So basis risk is the risk that the basis will change unfavorably between the time a hedge is placed and when it is lifted. So at say time 0, I have entered into a futures contract for time F in future. Now basis is the spot price minus future price into conversion factor. That means what is the future price? Future price is spot into 1 plus rate that we saw earlier. Now if the future price and the cost of carry is having a difference, that means your future price based on the spot price is not equivalent to the expected return. There is a basis risk. That means your spot and your future will not converge. That the spot price and the future price will not convert. So that is called the basis risk. So we understood that in a perfect market, there should be no arbitrage opportunity. Why? Again, the same formula, future is equal to spot into 1 plus the cost of carry. So if there is a difference in the prices of futures and the spot based on the cost of carry, there is a basis risk. That means what you're expecting the price to be in future, it will not be that same price, and there will be sellers and buyers in the market in the futures which will try to exploit this arbitrage between the spot and the future market. Once they start exploiting the arbitrage, slowly and steadily the prices will converge. But as long as there is a difference in price, the arbitrageurs will take the positions and try to gain from the basis. So basis is basically the difference of the expected future price based on this formula, that the future price should be equal to spot times the compounding effect of the rate. Indian banks do not get into. Now let's see arbitrage opportunities. In theory, there would be no arbitrage, but in practical scenario, there would be an arbitrage wherein the future price might on maybe or above or below the fair value. Now from the formula, we know that the fair value should be spot into 1 plus rate, right? This is the formula that we have seen earlier. Now suppose for one bond futures contract, the fair value is 101.6. So this should be the actual future value in 3 months, right? But the 3 month futures is trading on 102, example. The 3 month future is trading on 102. That means the actual formula based pricing is 101.6, but the actual market is quoting 102. That means the futures price is greater than the fair value. Futures price is greater than the fair value. If there is a scenario where the future price is greater than the fair value, you will do a cash and carry arbitrage. Basically, you will buy the spot. Let's say the spot is 101.4. Example, spot. You will sell the futures. I'll add plus. You will sell the futures. Why will you sell the futures? Because as per the formula, the future value should be 101.6. But the future is mispriced at 102. That means the future is overpriced. And what you do of overpriced assets? You sell them. So here you will sell the futures and buy the spot. So when this spot, after 3 months, it will converge to 101.6 because that is its fair value from here. And you have already sold this asset at 102. That means the difference between this and this is your profit. Because you are able to sell an asset at 102 whose fair value is 101.6. Reverse cash and carry arbitrage is when the future price is less than the fair value, opposite of this. Suppose now let's erase this one and let's take a fresh example for the reverse cash and carry arbitrage. Now suppose from the formula again, futures has to be spot into 1 plus rate again. Now based on this, suppose the future value is 101.7 example. So this should be the no arbitrage price for the futures price or the fair value. But actually in the market, the futures price is trading at 101.5. So the asset value in future should be 101.7 based on this formula, which is a no arbitrage formula. But the actual price in the market on the trading terminal is what you are seeing as 101.5. Now here the future price is less than the fair value because future is 101.5, fair value is 101.7. What will you do? You will short the spot. Suppose the spot is trading at 101.4. So you short the spot and buy the futures. Why will you buy the futures? When you buy the futures, it will be 101.5. Because you know the futures price 101.5 will have to come to 101.7 to establish the no arbitrage condition. No arbitrage means the future value has to get compounded at the rate which is given multiplied by the spot rate. So this should be the actual value, but this is the value. So you are buying an asset which is expensive at a lower price. That is why you will buy the futures and sell the spot. So this is one of the example for arbitrage opportunities. Now, what is the role of interest rate futures in portfolio management? Let's understand. These are complex subjects. Duration management. Suppose you are a fixed income portfolio manager and your portfolio duration is 8 point is too much. Let's take 4.5. This is your portfolio duration. Now that means the average maturity of your portfolio is 4.5 years. Now if you want to increase or decrease the duration, you can buy the futures to increase the duration or sell the futures to decrease the duration. So suppose if I have a view that my portfolio duration should go to 4.2, I might not go into the market and actually sell my portfolio to get it to 4.2. I can enter into futures contract and sell the futures. So this 4.5 minus say 0.3 duration futures, I might reach at a duration of 4.2. So quickly adjusting portfolio duration without buying or selling the underlying bonds. I'm not buying or selling the underlying bonds. I am buying and selling the futures. So duration management is one role. Tactical positioning. Implement short-term interest rate views while maintaining core holdings. Again, let's take the same formula. My portfolio holding is some X millions and the duration is 4.5. Now in the longer run, I know that the portfolio is good and safe and sound, but because of say some technical issues like Fed repricing or there is some war which is going on, you have a view on the interest rate movement either on the upside or on the downside. You want to benefit from this without touching your core portfolio. So you don't want to touch your core portfolio because this looks like a sensible portfolio from a long-term perspective, but you want to benefit from the short-term movement of the interest rate. So you can enter into futures and take a short-term trade and benefit from that. So that's called tactical positioning. Yield curve strategies. Express view on yield curve shape through spread positions. What is spread positions? Let's understand. We had done this earlier in the color section. Suppose I have a view. Let's take another color. Suppose I have a view on the yield curve. So I can actually benefit from the yield curve movement without touching my portfolio. Suppose my portfolio is at 4.5. I don't want to touch it, but I want to make some money using the bond futures by riding the yield curve. Riding the yield curve means I can buy bonds across the yield curve, or by the strategies of yield curve by buying the long-term bonds and selling the short-term bonds. This could be one strategy. And if the view is different, then I can sell the long-term bond and buy the short-term bond. So depending on the view, I can actually trade across the yield curve using the using the interest rate futures. So I can benefit from the yield curve movement. Either it could go flatten, or it could go steepen, or it could remain like this. I can benefit from this movement without actually touching my core portfolio by entering into the interest rate futures market. Similarly, we have the fourth term, which is cash equitization over here. Let us understand what is cash equitization. See, suppose you are a fund manager, so you will have a lot of people giving you cash in the fund. Let's say fund A. But you are planning to keep 10% of this cash as a liquidity buffer, or you don't have any investment horizon, investment opportunities. So you want to keep this as cash. Now this cash is not invested in the market. That's why it's not earning any return. It is not earning any return. So 10% of your portfolio is not earning any return because you have kept it as cash. But what can you do? You can maintain the cash positions in the fund and still enter the market using a futures contract where you will pay only the margin. Because for the futures, you don't need to pay anything else, right? You need to pay the interest initial margin, and then thereon you have to pay the maintenance margin. So here 10% of my AUM is kept as cash, which is non-utilized. So it is not earning any interest, but you don't want to sell those, you don't want to buy this bond actually and get out of the cash. Instead, what you can do is you can buy an interest rate future, say a T-bill future, and the return from T-bills can be added to the cash, can be added to the fund performance. That is known as cash equitization. That means you're actually not using the cash, but you're still getting the returns from the market by entering into a heavy position into the futures market. So this is a portfolio management technique used by fixed income portfolio managers specifically to avoid the cash drag. Cash drag means the negative returns because of holding cash, because cash will not earn any return which is above the risk-free rate. So that is the cash equitization. Now regulatory framework is self-explanatory, SEBI and RBI regulations. I'll just pause the slide over here. You can read it yourself. But there are certain things that you need to be aware of. Under SEBI regulations, it regulates the exchange traded interest rate derivatives, and the RBI provide guidelines for participation by regulated entities like banks. Hedging versus trading limits. As a bank, you might not get into trading. Indian banks do not get into trading, but they get into hedging. Accounting and disclosure norms. So as per RBI guidelines, there is some accounting norms that is to be given for interest rate derivative products. Monetary policy considerations. Monetary policy consideration means if the interest rate movement is against the open market operations done by RBI guidelines. So there are certain guidelines that you need to follow while entering into a interest rate future contract as a bank or as a entity. And SEBI regulates the exchange trading of the interest rate derivatives. Contract is fixed and designed, so that is the lot size and the tick size. Participant eligibility criteria is designed. Not everyone can get into the interest rate futures market. Position limits and reporting. So there is a specific reporting format that has to be provided in which your exposure to leverage, your current mark to market, everything has to be posted. So this is the dual regulatory framework. Interest rate futures comes under the dual regulatory framework. Why? Because the main participants in the interest rate futures are banks, and banks are regulated by RBI. So that is on the regulatory framework. Then this is the history of the interest rate futures in India. So it was launched in 2009, initially only for 91-day T-bills, 10-year G-Secs. In 2009 was the initiation. 2013 it got expanded into more categories and relaxation of certain restrictions for investors. Between 2016 and 2020, new types of products, contract tenors, and options on futures were introduced. Right now, since 2020, efforts are going on to make the market more liquid. See, interest rate market in India is not that deep or not that liquid. The reason being the participants are majorly banks, right, and large fund houses who are doing it for hedging perspective. So the market is still evolving for interest rate futures and interest rate derivatives in India. So it's still under development. It's not that highly liquid compared to the global peers. And this is what this slide is saying. Interest rate futures markets vary significantly across countries. In the United States, it's a highly liquid market. We all know because all these things have originated over there. And US Treasury is one of the most traded instrument in the world. So United States is a highly liquid market. Europe is also a highly liquid market. Euro offers Eurobond, BOBL, and futures. Sovereign bond futures also are issued in the European market. Asia Pacific, Japan is the largest player over here. India is a developing market. So JGB futures, which is in Japan, is the largest in Asia. In Europe, Eurobond and sovereign bonds are also issued. United States is the highest liquid market for interest rate futures. CME is Chicago Mercantile Exchange. Chicago Mercantile Exchange is the full form of CME. So this is an exchange under which the interest rate futures are executed. A session, the first one being the standardized contracts. So exchange traded contracts are standard in nature. That means the lot size is fixed. The contract size is fixed. The tick size is fixed. So it's standardized contract, no customization. Pricing fundamentals, we know that future is equal to spot into 1 plus the rate. If this does not hold, that means there is an arbitrage opportunity. We saw the application in hedging interest rate risk, speculating, managing the yield curve, managing portfolio duration, and market evolution. So we saw that interest rate futures in India is still a developing market. It is not developed as deep and as liquid as the equity market, mainly because of the restrictions, the regulations, and the market participants, which are primarily banks and large fund houses. So that is why this market is still evolving, and it is evolving at a good speed as of now. We also learned that the markets are regulated by RBI and SEBI both. So interest rate future comes under dual regulations. RBI because the main participants over here are banks. So with this, we complete the chapter number 3. In the next sessions, I think so we'll cover the interest rate options and other items. Thank you.
Yeah, hi. So I saw a little question. So will conversion factor be different for different bonds? Yes, conversion factor will be different for different bonds because see, there could be when I'm trying to deliver a theoretical bond, there could be a bond which is at a lower yield and the other bond could be at a higher yield, right? So both of the conversion factors to make it comparable, both will have a different conversion factor. So yes, conversion factor will be different for each of the deliverable bonds. And just one more announcement that there is slight change in the schedule for the next series of videos for the next week and the week after that. I think so that will be published on the dashboard as well as you must have received an email for the revised schedule for the upcoming webinars. I think so. We can now move to the question poll. So I think so. The first answer, most of you guys have got it correct, which is the cash settlement. So the 91-day T-bill futures will always be cash settled. The first reason, it is a very short-term instrument, a 91-day, and it is available across, right? So it is possible to buy 91-day T-bill futures from the market itself. So no one will actually ask for a physical one. It is mostly traded. It's a very liquid instrument available in the market at all point of time because it is issued by the government of India or the RBI. Which of the following is the last trading day? Last trading day in India is last Thursday of the contract month. So that we know from our FNO that in India, the last trading day or cash settlement day is the last Thursday of the contract month. So half of you have got it right. Most of you have entered the wrong option, which is the second one, 2 business days. Then the total number of derivative contracts outstanding is called open interest, which most of you guys have got correct. As we know that the definition of open interest is how much contracts are open, hence the name open interest. Then question number 4, most of you guys have got correct. Some of you have got it wrong. The explanation is you have already shorted the future at 100. That means you have sold at 100 and the stock has moved or the futures have moved to 101. Now, if something you have sold at 100 which has moved to 101, that means you have made a loss of 1 rupee. And lastly, the calculation is very simple. We know that the face value of a bond is 2 lakh rupees. So lakh into 99 into the lot size, which is given as 10, you will arrive at the number of 19,000, 19 lakh 80,000, which is the option number C. So which is the formula for computing the value of the contract, which is lot size, which is 2 lakhs. Each of the answers. I think so. We will meet in the next session, which is going to be on interest rate options. I'll see you then. Thank you.